Hi, good morning, everyone, and welcome to the latest BCO NextGen webinar. I'm Alex Novelli from Cushman and Wakefield, and I'm one of the committee members for the NextGen in London. In today's webinar, we're adopting a slightly different approach to the Inspirational Leaders series, and I'm delighted to be joined by two research professionals from Savills and Cushman and Wakefield, who will be providing an update to us all on the status of the London office market, both from an occupational and capital markets perspective. Whilst our day-to-day lives have all changed in recent months as a result of the COVID pandemic, the fallout on the commercial markets is yet to be seen in full, and it is likely to be some time still before the effects can be measured. During this time, we've all seen the incredible work that frontline services have done to help us in the country through this crisis. So before we begin, we would ask that in return for supporting and you joining this event, that you also support the NHS in providing a donation today. A link to the website will be sent via Zoom, so please do look out for this. Our first guest speaker today is Ben Raywood of Savills. Ben has been at Savills for 6 years now and focuses primarily on the occupational markets within central London. His work is referenced regularly within publications such as the States Gazette and Property Week. And Ben is going to walk us through leasing activity in London during the first part of the year. Ben will then hand over to my colleague Greg Mansell, who is the Head of UK Research and Insight at Cushman and Wakefield. Greg is responsible for UK market research, forecasting and thought leadership, and will focus today on investment activity in central London. Both Ben and Greg will welcome any questions that you have during the webinar, so please feel free to send these through via Zoom, and Hannah Buxton from Savills, also a committee member, will address these at the end of the session. So to kick off today's webinar, I'll hand over to Ben and Greg.
Brilliant. Cheers, Alex. Good morning, all. I hope you're all well. I'm Ben Raywood from Savills, and I'll be covering the London occupational market. Now, as you can imagine, there are more questions than answers at the moment. Given the unique nature of the situation, it is difficult to draw complete conclusions from previous market downturns. However, while it seems inevitable that we will experience some form of recession in the near term, the market fundamentals are in a stronger position now than in entering previous downturns, which can provide some form of encouragement. What is encouraging is these Oxford Economics forecasts for office-based employment do not currently predict there'll be a dramatic decline in employment figures. Granted, it is likely we will see unemployment continue to increase over the next year across all sectors. However, it would seem the worst affected industries are not necessarily office-based, for instance, hospitality or retail. In fact, they are predicting just a 0.003% decline in total office-based employment in central London this year, before increasing by 1.6% by the end of next year. However, while this makes for positive listening during this time, it should be noted that the real question is how many of these office-based jobs will remain actually based in the office going forward, and how many will remain as remote working, either part-time or full-time. Here we're showing leasing take-up by quarter historically, and the central London leasing market has coped well with uncertainty over the past 3 years, while we've been navigating our way out of the European Union, which we must remember is still not entirely resolved. However, take-up has been at or above the long-term average for the past 7 years. Even 2016, which saw the referendum take place at the midpoint of the year, still surpassed the long-term average in both markets. Q1 of this year started strong in the city, surpassing 1 million square feet, finishing 16% up on Q1 last year, although this was significantly aided by Linklaters acquiring 300,000 square feet at 20 Rokemaker Street. However, Q2 has been hit as expected, and we have seen just 240,000 square feet complete in the city in the past 2 months. Q1 in the West End was less robust in comparison, reaching 600,000 square feet, which was 55% down on Q1 last year and the smallest Q1 since 2009. Although the West End did not benefit from a Linklaters size deal, the largest letting saw Google acquire 135,000 square feet of short-term space at Euston Tower, and the next largest deal was for just 36,000 square feet, with the office group acquiring space at Liberty House. Q2 has been hit similarly like the city, with just over 200,000 square feet transacting in April and May. Now, the sectors from which this take-up has come from has been very similar in both the city and the West End in the recent past, providing further evidence to the notion that the central London office market is becoming increasingly more homogenous. The tech and media sector have accounted for the greatest proportion of take-ups since 2019 in both markets, with the insurance and financial services sector close behind. Since lockdown began, the professional services sector has accounted for the greatest proportion of take-up at 27% across the whole of central London, the largest deal being Covington and Burling acquiring 86,000 square feet at 22 Bishopsgate. Looking forward in the short to medium term, we're still expecting the majority of demand to come from the tech and media sector. And we're still of the belief that the expansion of these large tech businesses will outweigh the anticipated reduction in space required from the insurance and financial services sector. We must note, though, how serviced office providers have been a primary source of demand over the past few years, accounting for 20% in the city and 15% in the West End last year. However, they have been involved in no deals since lockdown began. Now, while I still believe there is a place for them in the London office market and occupiers will still choose to use them, albeit at a premium to traditional offices, in order to benefit from the flexibility they provide in these uncertain times. I feel it is very likely we will see little to no action from the large providers, at least for the remainder of this year, especially WeWork, who are actively looking to reduce costs. Now, one key aspect of the London office market for the past 6 years has been the consistent lack of space available and the low vacancy rates as a result. Here we are showing how many months of supply remain in either market at the current rate of take-up. So we average the rolling monthly take-up and divide it into the total supply figure. And currently there is just 14 months of supply in the city remaining and 17 months in the West End. This is still way below the oversupply point of 20 months, which after that is when we normally see real rental falls. Furthermore, the actual current vacancy rates are very low in a historic comparison. The city is currently at 5.3%, down on the long-term average of 6.6%, while the West End is currently at 4.3%, down on the long-term average of 5%. However, we are anticipating the vacancy rate to begin to trend upwards due to the arrival of tenant grey space on the market as a result of the impending recession, but also the expected switch to a more remote style of working and therefore a smaller requirement for office space. Tenant supply is currently approximately 30% in both the City and West End, in line with the long-term average. However, as you can see on the left-hand side, this has been on a steady increase over the last 2 months. Since lockdown began, tenant space across the whole of central London has increased by 18.7% due to the arrival of 560,000 square feet of grey space. This brings total tenant space to just under 3.6 million square feet, which in quantum terms is still 8.7% below the long-term average, although we are seeing new grey space arrive to the market every day. So this is certainly one key metric to keep an eye on. Now, it's interesting to see that so far the share of this 563,000 square feet of new tenant space over the last couple of months has come from a variety of sectors, but the tech and media sector accounting for slightly the most at 22%, followed by banking and insurance and financial services, both at 17%, and the retail and leisure sector at 15%. However, over half of this new grey space was already predetermined to come to the market regardless of COVID. In fact, just 36% or 200,000 square feet is a direct result of the pandemic. Another key metric to watch over the coming few months will be the level of under offers. Starting at about 3.12 million square feet before lockdown, this has now dropped down to 2.6 million square feet. However, in that time, we have seen 560,000 square feet of this space complete, with just 13% or 413,000 square feet fall away. Furthermore, An additional 489,000 square feet has actually been placed under offer during lockdown, showing that while the whole industry effectively shut down, business was still being conducted in order for occupiers to tie up their desired office space at a point where the competition would have been extremely low. However, with the overall level of under offers falling, it is likely we will see a muted Q3 in comparison to the long-term average. Now, looking forward, the level of requirements we are currently tracking is healthy and diverse. There's a total of 11.2 million square feet targeting office space in London, with 55% of this not having a preference as to whether it is in the city or the West End, again adding weight to the increasing homogeneity of London. The spread between sectors is varied, with banking and financial services accounting for a quarter, followed by professional services at 24%, tech and media at 17%, and the public sector at 15%. Now, prior to COVID, we were repeatedly saying how constrained the future pipeline is across London, and therefore the chance of oversupply arising in the market to be minimal. The continued influx of tenant space to the market will of course affect the vacancy rate, trending it upwards over the next year. However, the current pipeline figures are low enough to not drastically accelerate this, and any space that is completing in Q3 this year is already included in our current supply stats. In the West End, there's 3 million square feet expected to complete next year, which is up on the long-term average completions by 81%. However, 52% of this 3 million square feet is already pre-let, leaving just 1.5 million square feet to arrive. In the city, there's 3.5 million square feet expected to complete next year, up on the average completions by 11%, but 28% of this is already pre-let, leaving just 2.5 million square feet of speculative space. In fact, 21% of the space between now and the end of 2024 across the whole of London is already pre-let, and it is possible that some of these schemes that are a couple of years away may now be delayed or scaled back in terms of size. Now, these are our rental forecasts from the start of the year before the pandemic had arrived here, and rents were looking likely to rise, assuming landlord confidence returned following the Brexit negotiations. We were forecasting prime rents in the West End to rise by 2.5% per annum, reaching £130 per square foot by 2024, and the city to rise by 3.4% per annum, reaching £92 per square foot. We were expecting the best rental growth to be in the West End fringes and the city core. And while this may still be the case, it is likely now that we will see some form of rental fall this year, the extent to which dependent largely on how much tenant space is released to the market, how fast it is then let up, but also how behaviours will change in regard to working in an office full time. We are then expecting there to be a bounce back next year once normality, as close as we know it, resumes. So to conclude, we are expecting vacancy rates across London to increase in the next 12 months, but this to be due to the influx of tenant space as opposed to a large pipeline of new schemes. It should be noted that so far the majority of tenant space that has come to the market has been for units of less than 10,000 square feet, and it is the smaller sub 5,000 square foot size bracket that has been hit the hardest since lockdown, especially in the West End, as the smaller occupiers may look towards more remote style working than large corporates in the long term. Headline rents so far have remained stable, although we have begun to see an increase in incentives, and therefore the extent to which we see falls in headline rents will be dependent on a number of demand factors over the next few months. I will now hand over to Greg Mansell from Cushman and Wakefield to give you an overview of the London investment market. Thank you.
Great, thanks Ben. So I'll also share my screen just so we can go through the capital markets slides. So just get them up and then get them onto full screen. Just check the view. There we go. So yeah, so thanks for that, Ben. What we're going to do now is try and get our heads around, right, what does that mean for the investment market? So all of these investors out there are looking through those stats that Ben just took us through and trying to work out Is this good value for the London market at the moment? What's the liquidity like? Who are the buyers out there? Who are the sellers? So I'm just going to take us through that kind of logic and that market that we're going to go through, just so we can get our heads around kind of what is the latest state of play, what might happen in terms of future trends as well. So this slide here just kind of helps us get our eye in as to the size of the overall market. So that bottom bar there is UK all property types. And in a typical year, typical 12-month period, we get around 50 billion of investment for this part of the market. Now, around half of that, 22 billion, is the London all property market. So London's around half of the UK total. Now, quite a bit of that London all property is actually London offices. So in a typical year, we get around 15 billion transacting. And that's kind of our number to keep in mind, given that that's our focus for today. But it's still worth pointing out that the city office market within the London market is a big proportion, 59% of the market, 54% of the market, sorry, 8 billion. And actually the city core is 5 billion in a particular year. So that little square mile patch generally generates around 5 billion of investment each year. So we've got quite a concentrated market from the UK all property level down into London offices, and so on. So if we look at how that plays out over time, keeping that 15 billion average in mind, we can see that it oscillates quite a bit. We were up above 18 billion before the financial crisis, down to 6 billion, and really it's been gradually building and building all the way up to 2015. That's when we got up to around 20 billion as a rolling annual total. Now, as we got into the, if you like, the Brexit phase of this market, the EU referendum bill passes, we can see that volumes are starting to flatline a little bit. Then we get into the referendum result, we can see how sharp that dip was. But then that was really because there were quite strong concerns that there was going to be a recession straight off the back of the referendum. When that didn't materialize, we started to see volumes start to pick up again. But we still had Brexit to come, we still had certain deadlines and a lot of parliamentary votes coming through. And those deadlines kept getting pushed back and pushed back. So we end up with quite a stop-start market all the way up to the general election last year. And really this year was billed as, at least we've got a bit of political certainty here. We know what the path is for Brexit. It's all down to these negotiations that need to begin. But we were expecting 2020 to be quite a solid year. Now, a solid year for London office market in historic context might be around 15 billion, but given how quickly values have grown, really is a market that's capable of 20 billion plus. But we haven't seen that start to kick up because the COVID crisis cut in straight in at the start of this year, and it's going to come back down towards those GFC kind of levels in the very short term. But I think what we'll look to as we go through these slides is just that the potential we can go from a very weak market in terms of liquidity far past the 15 billion and probably looking at 20 billion plus. So let's have a look at how and why that would be. Well, there's a few things that we need to know about that's underneath the surface of these numbers. First, we've kind of covered that the city London office market is 50% of the greater London market overall. It's highly concentrated and a big part of that market there. Second is who are the people that are buying here. So it's foreign buyers are the majority of the share. This is a very long-term trend. We kind of went through that 50% tipping point where there were more foreign buyers than domestic buyers quite a while ago, pretty much in the last cycle, but it's really continued through. But there's a few things happening there. So the domestic market have generally been the traditional owners and then therefore been the sellers. So it's been a domestic seller to a foreign buyer. Most are trying to sell out of these assets because most of these London offices have been attached to funds and portfolios that are attached to defined benefit pension schemes that are mature, they're not growing. And a lot of our funds in the UK, the domestic market, are generally a little smaller, and having some of these big assets in their portfolio was seen as a hindrance to their diversification. Whereas a lot of the big global capital that's been raised since then had a very strong appetite for London offices, generally being on the buyer side. But really what we're seeing these days is quite a strong mix between domestic buyers and sellers and foreign buyers and foreign sellers selling to each other. So we're into that kind of second generation churn within our market. It's heavily institutional, naturally, given the market size. Around 3/4 of all deals are institutions. High net worth individuals do buy into the London market, and they do buy big when they do, but it's generally a smaller part of the market. And the top 10 deals are generally around half to 2/3 of all deals. So just to give you an idea, in a typical year, we generally see around 200 deals. So the fact that the top 10 has such a large share is quite unique to this market. And generally, they're all single asset deals as well. Portfolio deals are less than 5% of all deals. So that, again, is quite rare for the market, but it's kind of typical given the average lot size. To give you an idea of that, as a median lot size, it's around 35 million at the moment. If you take the mean, given the skew to the bigger deals, you're getting closer to 40 to 50 million. So they're big tickets for these kind of investors. So if we look at who's been investing in this cycle, we've taken that as a starting point from 2006, just so we can see who came in at the top end of the last cycle, who invested through the downturn, and who's been investing more recently. We can see kind of out the top 20 buyers, a real mix, but they're all the big names. So from Blackstone all the way down through to Aviva, we've got a mixture of big foreign investors, some of our biggest domestic investors as well. But we can see the timings have been slightly different. We can see, say, Evans Randall were heavy investors at the end of the last cycle, but haven't really been that active. Since then, Blackstone have been very consistent, and a mixture of small and quite large deals. And we get kind of sovereign wealth funds that would buy a big ticket and then go quiet for a while. So GIC is a good example of that. You can see that kind of profile where just through a few deals, they can really eat into billions of pounds worth of investment. I think it's also worth pointing out that although we might not talk about, say, our domestic investors like Legal & General and M&G, they are big investors in London. It's just little and often. They might not get the biggest deal and the big headline in each quarterly report, but over time, they do invest quite heavily into what is their main domestic market. I think finally, it's worth pointing out that although there's a lot of investment from this group, they're only 22% of the investment that we've seen through that last cycle. It's a really deep bench of investors. Over 1,000 investors domestically and foreign have invested over the last 10 years. So it's a very long list of potential buyers and sellers that rely on London for their exposure to the real estate market. So that's kind of helps us get our eye in. So really what we're wondering is what's happening right now in relation to this crisis. So we do track a lot of deals as they're progressing through from when they're marketed all the way through to the point that they complete. Now, to get our eye in, we'll start off with the deals closed, that red line there. So we're really starting the clock at the start of March. So we're starting at 0 in terms of number of sales. And we saw through March that these sales were progressing at quite a good rate. If we extrapolate that angle, that line, we're probably going to get to around 4 billion by the end of this chart, end of the quarter. So say 3 billion for Q2. So that's fine. That's going to be in line with what we're expecting, that back up to 15 billion, maybe on our way up to 20 billion on a rolling annual basis. But you can see the sharp right-hand turn that red line takes as soon as we get to lockdown. Very few deals have been able to progress. That's natural. Just the functionality of being able to, of this market to function, just being able to visit those assets, do the due diligence, move these deals through. So when we get to the end of the quarter, we're going to have a very, very small quarterly total for Q2. And that will be what the main reports are. But I think what's worth pointing out is what's still in that pipeline. So if we take a step back into the deals progressing, we have around 3 billion that are currently under offer that's trying to move its way through. Another 3 billion that are at the bid stage. So just in that immediate aftermath of what might be quite a low total, given that today, as we speak, site visits and tours are starting to get underway again, we've got a 6 billion backlog that's going to move through the market quite quickly. And that's exactly what we had in the financial crisis as well. Q4 in 2009 was a really big moment for the London office market. We had a lot of deals that were postponed or pretty much lined up, but just waiting for that turning point to be clear for the London market. And then in the back end of 2009, a lot of deals went through almost all at the same time. And then there was a bit of a lull. We're probably going to have that same issue again, where we have a big passing through of quite a lot of investment. And then when you look at what's available on the market, there's less than 1 billion available at the moment. So we're naturally going to have that lull once the deals that are in progress complete. Now that 1 billion total of available, that's only 8 properties, just to give you an idea of just how concentrated it is. One of those assets is around 500 million. So there's not much available stock onto the market. There's been 2 billion that have been withdrawn pretty much since lockdown. You can see that some investors decided to shelve their deals. It was not really practical to try and progress. It's highly likely that they'll come back onto the market quite quickly, but they're starting at square one. So there's another 2 billion that might come back onto the market again. So we're kind of saying, well, all right, so maybe less than 1 billion this quarter, but then there's another 3, another 1, another 2 that's going to come and pass through the market as soon as it becomes practical to do so. And in terms of appetite, the likelihood of that coming through is going to be quite high. Let's not forget that in 2019, last year, that over $150 billion was raised globally for real estate looking for assets, and London will be on their target list. Now, of those, of that capital raised, that was only raised by 194 funds. Now, to give that some context, that's the lowest number of funds that managed to close in any given period for the last decade. So a lot of money in very few funds. So they're looking, so you can imagine that naturally that these funds are going to be very, very large, particularly Blackstone and Brookfield, great examples of that. Big funds looking for big ticket items, and there's only a few places in the world where you can find that, and London office is going to be one of them. So everyone's looking for this availability rate to pick up, because that capital has been raised from last year. They're looking for opportunities throughout this year, and they're sitting on the sidelines at the moment. So how's that dynamic affected pricing? Well, it's quite difficult to ascertain exactly where yields are, given the low levels of sales completions, but also the limited amount of activity that we've seen so far, or at least to the year to date. RCA managed to model this, so it's not just a simple average of what's being transacted, but at least they're real deals. What was the yield on that completion? And then let's turn that into a market level average. They make some subtle adjustments, so it's not going to be skewed up by some big offices or some poor quality offices moving the average up or down. They make there's a little bit of maths behind there. They've got a hedonic model basically that does a bit of that work. What we've seen is for City and West End yields, they're low and they've stayed fairly stable. There's a bit of noise there, but not too much. And you can see the differentiation between the two has largely been stable again. But we know that only prime deals I've been going through. Anything that's a bit more secondary or tertiary just simply isn't on the market, won't be contributing to the total. So naturally, the adjustments that RCA are trying to make can only take us so far. So we're seeing things like the West End yield starting to come down when you really just got big question marks against some of the poorer quality stock and what is the yield that's required there. My point for the capital values, you can see kind of how that's the yield movements and the rent movements, what that's done to values over the cycle, how they're quite high in historic comparison, but they've been fairly stable, treading water in the City, a bit more volatility in the West End. I would still point out that if we think about back to those volumes over time, when we got to that 20 billion and then it started to dip back down again, and I'm saying, well, this market's capable of more than 20 billion. Look what values have done since 2015. On average, these properties are worth far more today than they were in 2015. So if we get back to a normal turnover of stock, the equivalent of 20 billion back in 2015 is going to be more like 23, 24, 25 billion today. So we just see just how strong that bounce back could be once we get to kind of normal levels of trading that we've seen in the past. So because of that difficulty around what exactly is the kind of the average yield, we generally look at, say, what is a hypothetical prime yield for this market. So take a typical good quality building, fully let, no vacancy. What kind of a yield would that sell on in the market? So our benchmark last year for the City was around 4, West End 3 and 3.75. What we've seen so far in some of those deals that have completed or they're under offer, we've seen some slight chips on those deals. So some that went through with no chip at all. That's what you saw in the red line. Now we're starting to see some of the other deals that were getting a bit het up about what they wanted, maybe a 5% chip here and there. That's looking like more like a 25 basis points movement outwards for this year, but then snapping back in again once the rest of the pipeline comes through. And then you can see the impact of that on capital values in the short term. So most of these investors are looking to buy into this market over a 10-year period. So when they're looking at, well, values might dip this year, really they're saying, well, what do we want to negotiate up front to compensate for that? But really it's a small issue considering what they want to do over that 10-year period with the asset, maybe a bit of asset management. It's a strategic play to have some exposure into the London office market. So over a 10-year blend, what's happening right now, the difficulty for this market to function and deals complete in this quarter isn't going to be a big issue for them when they're thinking about what decisions they're going to be making in terms of investment. So overall, I think the three themes are going to be the big deals will continue. That's always been the case. That continued all the way through the financial crisis as well. It might be natural to think that in these kind of moments of crises that the big deals are the ones that fall away. Kind of it's a bit too much money to put in the market into one deal. But actually what we've seen in this case, again, is a lot of investors had to review all of their ongoing deals. Most had to go back to the investment committee. You can imagine how natural that bottleneck would be, and they prioritized their biggest deals. So to review those, you know, it takes the same amount of time to review a £500 million property as it does a £5 million. And naturally, they, after making those reviews going through, and given that those big deals are generally the big strategic plays they're going to make, we want a big office in London, we want an industrial portfolio, we want to move into healthcare. That's still the strategic plays that they are making on behalf of their clients. And generally, those deals continue to move through. It's the smaller deals that have fallen away. The number of deals has fallen quite dramatically for London. So those 5, 10, 15 million pound properties that people haven't had the time to review, they've been shelved or cancelled. And you can imagine if you're doing investment at this kind of level, a £5 million property, even if it's the perfect property, isn't going to move the needle, whereas the big deals are, and they will continue. Long income's important. London offices is pretty much one of the last kind of areas where you still get 15, 20, 25-year leases. They're rare, particularly compared to history, but they can be found, and they're even rarer in the rest of the UK market. But in the European market, they're rarer still. So there are lots of institutions, pension funds, insurance companies that want to hedge, they want to liability match, and they want to that long-term income. That's real kind of attractive aspect of that investment. And London offices ticks that box. And a yield of 3.75, 4.5. That's a good yield compared to something of equivalent duration in the fixed income market, and that's still going to be true moving forward. And finally, sustainability is going to be a key issue moving forward as well. And the quality of new developments for London, ticking all the boxes in terms of certification, but also trying to build a case for what occupiers want as well in terms of their sustainability needs. A lot of those answers are coming in good quality stock for London offices. So really we're looking not just sustainability, long income and deal size. It's going to be a bit of a two-tier market in the short term. Big prime assets that tick all those boxes are going to be in higher demand moving forward, but a poor quality asset is going to really see their yields continue to move out over the next year or two. So we'll see a real divergence in terms of what is good and what is bad. So I'll leave it there. I'll hand back to Hannah to lead us off on the Q&A, and I'm happy to cover off any questions on that.
Well, firstly, thank you very much, Ben and Greg, for both your fantastic presentations. A lot of information for us all to take away and digest. We have had a couple of questions through. So I'll start with one for you, Greg. Given the recent quarantine measures implemented in the UK, how is this going to impact upon foreign investors purchasing buildings in the London office market?
Yeah, it's something that we've been discussing as this group, but also internally as well. Just kind of what will be the impact moving forward. So, obviously, I've portrayed the London office market as being really heavily focused on foreign investment, but a lot of those investors have people on the ground in London. A lot of European and UK headquarters are in that market. So we've had a little look through and just give you an idea of scale. If we just take the last 3 years, around 189 billion of investment has occurred in the UK market. And 89 billion of that has been foreign investment, so about half, so there we go. But half to 2/3 of those investors have offices in London. They have people on the ground here. So even though the capital itself is foreign, it's being invested by local offices. And that doesn't include foreign investors that are investing with a local entity. Maybe they've got a separate account with a particular manager as well. So it will be an issue for smaller markets, perhaps if we get into continental Europe, Central Eastern Europe, where they don't have people on the ground. But for London, by coincidence, if you like, under these circumstances, there isn't really a limitation because of the travelling restrictions and quarantine to the total amount of investment that can come through. And the one little exception will be if people travel regularly or need to travel regularly, at least weekly, into the UK, they're exempt from those quarantines. So if someone, say in AXA, is based in Paris and they take the Eurostar once a week, in order to view these properties, they will be exempt. They might have to make their case for that, but that is also possible.
Great, thank you. So moving on to a leasing question for Ben. Whilst headline rents have remained fairly stable in central London over the short to medium term, and we kind of predict them to too, what have you seen with regards to the rent-free periods, accounting for any recent deals that have been done during this lockdown period?
Yeah, I mean, with the deals that have completed during lockdown, we haven't really seen any chip on the headline rent yet. Rather, the rent-free periods have slightly increased, which is entirely understandable given the present situation. Rent-frees had begun to come down last year, settling about 20 months in the West End and 22 months in the City on a 10-year term. However, during lockdown, we have seen these increase by about 2 months on average in each market. So it's difficult to say exactly at which point do we begin to see no more increase in incentives and a fall in headline rents. But to me, it feels like we are getting close to the ceiling in terms of incentives.
Great, thank you. I think we've just got time for a couple more questions that have come in via the chat. So one again for Greg. Hi Greg, what does the current activity in the listed market tell you about the demand for London real estate?
Sorry, yeah, so in the listed market, yeah, so it's been quite a good indicator through this period, perhaps not so much for London offices, but we've just seen how strong the negative, if you like, sentiment for retail-focused REITs has been a precursor to what we've seen transpire into, for example. The London office market, they kind of got dragged down quite heavily in terms of share price straight after lockdown began, but they've been starting to rally in back again. So I think investors have really taken a bit of a step back and taken into account pretty much what Ben was describing: very low vacancies, good activity across the board in terms of the tenant market, looking at what deals have gone through in the investment side. Have there been big chips? No, there haven't. It's been kind of 0 to 5, in some cases 10%, where there's been a bit more income risk, and then reassessed each of those REITs to say, well, actually, a lot of these REITs are low in terms of gearing. They've got good weighted average unexpired lease terms, so they're good on the lease length as well. They've managed their development pipelines quite well, so in terms of development risk, they've managed that ahead of this curve. And for a lot of this, it's kind of, they weren't kind of preparing themselves for a crisis like we're in right now. They were kind of starting to wind down in terms of risk because they saw Brexit on the way. We've had an excellent run for the markets off the back of the financial crisis from 2009 all the way through. So they've been quite prudent in that respect. So where a lot of these REITs and listed in the listed market have shown that level of prudence in terms of income risk, development risk, and gearing, that shows just kind of the investor attitudes live in real time, and that's kind of going to be reflected in the private market. So it has been a good indicator, but we have kind of gone through that kind of downturn in terms of the share price, and then starting to come back into a bit more of a logical assessment of what's happening on the ground.
Great, thank you. A lot of questions coming in now. One for Ben. How are vacancy rates likely to be impacted if there's an increase in service office operators looking to offload any of their existing centres in central London?
Yeah, I mean, this has been a concern for like the last couple of years, really, following the rapid expansion of serviced office providers, but in particular WeWork. There have been a few rumours recently that WeWork have been grading their centres on with the weak performers then being identified, and therefore at threat of being released to the market as grey space. And I'm sure other providers will be doing a very similar analysis. So if there's a complete failure of WeWork and all of their current occupied space came to the market, the overall central London vacancy rate would increase by about 100 basis points, rising from about 4.8% currently to 5.8%. That would push it above the long-term average of 5.2%. However, I think that's quite unlikely. And instead, we'll see only a small proportion of their stock come to the market, if any at all. I mean, some could argue that the serviced office providers could capitalise on the uncertainty at the moment by providing occupiers with a short-term flexible option until they then have a better idea as to what their long-term office requirement would be.
Great, thank you. So I think we'll leave it there with the questions, but I would like to say a big thank you again to Ben and Greg for your time. This session has been recorded and it will be shared with all attendees via email. So please do get in touch with Ben and Greg if you have any questions that you haven't had answered today. We will also be uploading this onto our new BCO YouTube page, so please do subscribe to that. And again, thank you to everyone who's also donated as well. We are, as a BCO NextGen committee, continuing with our series of digital events, with our next being another Inspirational Leaders webinar with Roger Madlin from British Land. So please do keep an eye out on your emails for details of that coming later on this month. Thank you everyone for joining us today.